There is an increasing shift where gold is becoming a very dominant reserve asset for many investors and savers around the world. I think many investors are worried about whether monetary policy in many of the world's prior reserve currencies is going to continue to be a regime where they'll have low and stable inflation, and so also have concerns about the durability of the dollar as being a storehold of wealth. But I think that primary motivation for that shift to the gold as a reserve asset is coming from the desire to have a safe storehold of wealth that's outside of the ability of the US government to control that wealth.
I'm Jim Haskel, editor of the Bridgewater Daily Observations. With the third quarter in the books, the market receiving the most attention by far is the gold market. Gold appreciated by about 50% year to date, and it recently rose above the $4,000 an ounce price for the first time. In the past several months, we've written a lot about gold in the Daily Observations. We wrote about gold's role in portfolios and what makes a top in gold. But given gold's recent performance, we thought this was a good time to step back and ask ourselves more fundamental questions about what the gold market action is actually telling us. Could we be looking at an international monetary reset, or is that overblown? Is gold on its way to becoming the world's reserve currency, replacing the US dollar? And what does the forward-looking picture look like for the gold market? To discuss these dynamics and more, I'm joined by Managing Deputy CIO David Trinh and Head of Contra-Currencies, Hudson Attar. Trinh, Hudson, I want to welcome both of you. Trinh, let's start with you. How do you think about this question as to whether we're looking at an international monetary reset?
Yeah, thanks, Jim. Good to talk to you today. So I think there is something big that is happening, which is there is an increasing shift where gold is becoming a very dominant reserve asset for many investors and savers around the world. That shift to gold becoming a more important reserve asset does not necessarily mean that the dollar is losing its reserve currency status. There are many qualities that the dollar has, being the primary unit of account in global trade, being the primary currency that people are denominating their debts in, and still saving a lot of their assets. Gold is not replacing the dollar across all those dimensions, but in terms of where people are saving reserve assets, particularly for sovereign wealth and for governments, we are seeing an increasing shift where many players across the world being worried about confiscation of wealth concerns, particularly after the Russian invasion of Ukraine in 2022, shifting their savings into gold in order to have a asset within their portfolio that is not connected to the Western financial system and that can be safe in the event of a conflict. Beyond that, there are other motivations for the purchases of gold. I think many investors are worried about whether monetary policy in many of the world's prior reserve currencies is going to continue to be a regime where they'll have low and stable inflation, and so also have concerns about the durability of the dollar as being a storehold of wealth. But I think that primary motivation for that shift to the gold as a reserve asset is coming from the desire to have a safe storehold of wealth that's outside of the ability of the US government to control that wealth.
Trinh, one thing that you didn't mention, of course, or maybe you did it indirectly, is this notion of just the glut of global supply of debt because of the high indebted levels of major governments around the world, and the fact that deficits are very hard to keep under control, such that interest rate servicing burdens are really high, especially in the United States. So my question here is, when you think about this safe asset, is it because the outlook for bonds, just given the amount of supply and given how the government may be able to handle that in lieu of a credible deficit reduction program, is monetization? And if monetization is there, that's what's leading to higher inflation expectations, and that's what's leading to a move away from nominal bonds into allocations to gold.
Yeah, absolutely. I think that connects to the thing that I was saying about how investors are worried about prior reserve assets serving as a storehold of wealth. Big government deficits are no problem if you think the central bank is going to run appropriately tight policy in response to those large deficits. So if the government borrows a lot, but then the central bank tightens interest rates and basically, conserves the amount of credit in the economy and forces the private sector to not borrow in order to make room for that government spending, there's no issue. And you can have the government having very large deficits and having the private sector being more contained and still have equilibrium economic conditions and balanced growth and inflation. The problem is that that can be a very painful process to force the private sector into that very tight monetary policy stance. And so what we're seeing across many of these countries is central banks deciding to run relatively accommodative policy. They're not forcing the private sector to cut themselves off. So you're getting very large government deficits alongside, still in some cases healthy private sector credit growth, which is creating worries about inflationary pressures and worries that the money today is not going to hold its value into the future because you'll be monetizing those deficits.
And then is it fair to say that the trends of Western investors into gold and away from bonds will really be a function of whether inflation really starts to become sticky or accelerate in the West? If that were to happen, I would imagine that there would be more consternation about bonds and more desire or demand to move into alternative assets.
Yeah, I think that's right, Jim. And I think for those Western investors, it's important to recognize, well, gold is a very effective hedge for currency debasement and protection against inflation. It's not their only avenue that they can go to in order to get that sort of portfolio insurance. If you're a Western pension fund and you're worried about this, yes, a gold allocation will give you some protection, but you can also buy inflation-linked bonds. You can buy equities, which generally will keep up with nominal growth. Not perfectly, but they're, certainly better than holding nominal government bonds. Now, some of those other avenues have problems too. Like say in the US, there was pressure on the BLS to change the inflation data in order to report lower CPI prints. That is a risk that could cause those inflation-linked notes to not deliver the type of protection that investors can get through gold. But there's a much wider set of potential ways that those investors can get inflation protection in their portfolios. And at this point, the rally in gold has made gold pretty expensive by historical terms relative to some of those other hedging assets. And so I think the question now for many investors in the West is it worth paying up and paying that idiosyncratically high premium that is developing in gold, in part because so many of these other investors in the world that are worried about the confiscation of wealth concerns and can't do things like hold U.S. inflation protected securities. Are you willing to compete with those investors and keep pushing the price up? I think at these levels in gold, while there has been increased demand from those Western investors over the past few months, that the most recent price move, I think, should start causing people to reevaluate those choices and think about whether it's so necessary to be concentrated in gold as that sort of portfolio insurance.
Hudson, I want to zoom in on the latest rally in gold. What type of buyers have been driving this rally, and are the sources of demand different than what we've seen before?
As we've talked about before on the podcast, I think it's useful to understand the gold market through the lens of the basic properties of the asset and the type of role that it serves in investors' portfolios. Gold is a non-yielding asset with limited supply, and it's an asset that when you own it, nobody else can take it away from you. It can't be confiscated in the same way that savings in stocks or bonds or other countries' currencies can, because they're, somebody else's liability. And so because of those basic properties, the value of gold rises when the expected return on alternatives like stocks and bonds falls, or when the value of having a reliable storehold of wealth increases. And that second piece, the value of a storehold of wealth, has what has really changed in the gold market over the last several years, really since 2022, when Russia was sanctioned for its invasion of Ukraine. Central bankers perceived that moment as a shift in the value of a storehold of wealth and a shift in the perceived riskiness of saving their wealth in somebody else's currency and somebody else's liability. And so that kind of kicked off a wave of purchases from central bankers that's ongoing to this day. And that's sort of the linchpin of the secular move in gold that we've seen in recent years. But that's not the only way that the storehold of wealth property manifests, right? For central bankers, it might be that confiscation risk, but for other players in the market, it can be other things. And so I think what you've really seen in the market in recent months that's driven the last bit of this rally up to the 4,000 ballpark is private investors and private wealth being concerned about things like fiscal sustainability, about the value of fiat currencies and the inflation risks of holding assets that don't have limited supply like gold. And so as you've had the combination of factors like the attempt to fire Lisa Cook, the uncertainty in the political situation in France, the election of a relatively fiscally aggressive candidate in Japan and Takaichi, and the ongoing US government shutdown is kind of fuel to the fire. Those factors have led to a surge in private investment demand for gold from the West. And so I think that it's largely those players, private wealthy individuals, that have driven the most recent rally in gold.
My next question, Hudson, is as we move now through $4,000 an ounce, and really the market just seems to be going up, but that also makes people wonder, like, are we in a blow off kind of thing after this big move, or are the fundamental dynamics that drove the rally earlier this year still in place?
I think it's helpful to just list out what those big shifts are briefly and to talk about each of them in piece, because I actually think there's three different big picture shifts going on that are motivating people to go and buy more gold than they used to. So the first one, and the one that we've discussed at length, is the rising conflict between countries and the associated shift towards modern mercantilism and away from globalism. That is, I think, really the story that drove central bankers to increase their gold holdings post Russia's invasion of Ukraine. And that narrative, I think, if anything, is intensifying and likely to escalate. And I think that there's good sort of logical reasons for that sort of conflict between countries to increase rather than decrease. And when you're in that conflict between countries sort of regime, it becomes risky to save in a way that is somebody else's liability, because the choice of whether or not to pay back or honor that liability becomes leverage over you. So that's the first, I think, major theme. And that theme, I think, is more likely to accelerate than slow down. The second major theme is the fiscal profligacy of the governments that issue the currencies that back the alternative ways that investors can save, the alternative reserve currencies and the currencies in which the major liquid capital markets are backed, like the dollar, to a lesser extent the euro, the yen, the pound, and so on and so forth. So you've seen a real divergence in the deficits that these countries are running and the cyclical positions of their economies. And that's happened because over time, I think governments grow accustomed to the privileges offered by other countries and investors wanting to save in your currencies. And so they sort of take those liberties increasingly until it reaches a breaking point. Until the governments of those countries get disciplined, I don't really see any reason for that to reverse. And I think, if anything, you've seen it continue to accelerate. And I think the third major thing that's come into the market is the questions around the independence and credibility of central banks and the degree to which they're actually going to protect the money versus bend to political influence. That, I think, incipient, and I don't really see a major change there. I think that the fundamental dynamics are still in place. The question, I think, is whether the rally has been sufficient to bring people's holdings of gold to levels that are commensurate with those pressures, right? The question is, if you're a central banker and you see your allocation to gold at 20%, 30%, you might be in the mindset of thinking, I want a lot of gold right now because these things are making it really risky to hold dollars or hold yen. But the reality is you now do hold a lot of gold. So what do you go do, right? That's the question for the gold market is, will these people continue to buy or not?
Hudson, as we wrap up our discussion, I want to ask you, looking ahead, where do you see gold headed from here?
I think the critical question for the gold market is whether the pace of accumulation we've seen from private wealth in the West is sustainable or not. I think if Western investors continue to go down this path of aggressive reallocation of their wealth into gold that we've seen over the month of September, this rally does have room to run. And that's not impossible, right? You've had a combination of factors that really do, I think, raise the risk of the tail outcomes for things like, inflation sustainability in the US. And you've had sort of the ongoing march of fiscal profligacy, 3 new data points on that over the last month. Like, these could actually be the things that sort of tip you over into believing, no, I do need that 5% or 10% gold allocation that everybody is talking about in the media is making a lot of sense. And so if that behavior shift is real, I think that the gold rally has a lot of room to run. If those private investors pull back, say, for instance, when the government shutdown ends, or when the uncertainty around Takaichi and the government in Japan is resolved, or when the UK finance minister proposes the budget. When any of these events happen, if you see sort of a cessation in demand as uncertainty falls, then I think that the remainder of the gold market is no longer able to support these types of prices. I think central bankers, the desire to own gold was enough to make a pretty bullish picture in the 3,000 to 3,500 range, but at the 4,000 level, I think it just gets a lot harder to believe that there's going to be enough demand in there to clear the market if the private wealth isn't coming in and taking down such a big share. So on net, I balance the factors, and I think it's probably the case that the next move in the market is down, not up. I think that this rally has been pretty ferocious. It's happened pretty quickly, and it's happened at a time when a lot of the physical Asian demand in the world is on holiday. Over the last week, China has been on holiday, and so you haven't really had that price responsiveness come into the market in the way I think you might going forward. You've also, I think, had increasing signs of this being sort of a gold specific phenomena in a way that doesn't really connect to the broader debasement theme that people are discussing as sort of as being the logic for shifting your allocations. You've had gold rally at the same time the dollar has rallied, right? And so maybe that's just a function of other currencies also looking riskier to hold rather than it just being the dollar being riskier to hold. But I think then you have to go and ask the question, well, why aren't 30-year versus 10-year yield curves selling off and steepening a lot? You haven't really seen that. I think that's the more pure expression of the debasement trade. You've seen gold kind of disconnect from Bitcoin. You've seen it outstrip silver relative to the normal beta of those things. So to some degree, it really does seem like there's a unique sort of gold specific demand here that I would probably bet on not being sustainable rather than sustainable. But I think it's just so important at the end of the day to be incredibly humble about these things. So I don't want to overstate the case. And I do think it's very plausible that we're in the early stages of a bigger shift.
So with that, let's bring this to a close. Trinh, Hudson, thank you so much for your time.
Thanks, Jim.
Thanks, Jim.